Hello, everyone. Good morning. It is so wonderful to see so many people here for our inaugural BFD event. I want to encourage folks who are standing in the back to make some space here with us. Get cozier, get comfy. We've got a couple more hours of amazing conversations, so if you are standing in the back, if you want to finish up your drinks, you can please come closer to the stage. Promise I won't bite too much. Well, thank you all for tuning in on the live stream and being here in the room. My next guest, she sits at the core of capital markets. She's the president of the New York Stock Exchange, and I'm so pleased to welcome Lynn Martin to the stage. Lynn, I want to first start off by congratulating you. You're coming up to the one-year anniversary of being at the head of the New York Stock Exchange. What surprised you the most over the past year? You know, we've talked at the beginning of the year, and things are a bit different.
What a year it's been, right? I mean, what a year for global markets in general, not just in equities. I like to say, you know, I entered the job, didn't really realizing that we would have a war in my first couple of months to deal with, all the volatility in the market. But I think today actually speaks to the thing that has been the most pleasant surprise throughout this all, which is the fact that people really want to convene. They want to be in person. And the way we think about product development, the way we think about service development is to convene with our customers, to be very in front of our customers, to have conversations with our customers, particularly now more than ever, given all the economic uncertainty that exists in the global markets, given all of the different focus that CEOs on our issuer community and our trading participants have about, okay, how long is this going to be? When's this going to end? What's your forecast? So many questions, and then you layer on the fact that CEOs more than ever are looking to do the right things in the market, embed ESG, deal with the investors that they have in their stock at the moment. So I'm thrilled, pleasantly surprised, as I said earlier, the fact that people want to convene, people want to have conversations. And we've been very deliberate in the fact that we want to be in front of customers. We want to be public facing at the moment. I think we have a very important role to play to be a very public-facing organization, particularly at times like this, where there's both economic and geopolitical uncertainty.
And you talked about just now that you're having these conversations, that question.
Yeah.
How long will this period of uncertainty, muddiness last? What's your best guess? When Jamie Dimon comes out here and says, we're going to have a recession, this is the percentage chance that we're going to have one, and Jeff Bezos tweeting, I mean, who should we be listening to at this moment?
I don't know who we should be listening to. And I wish I had the crystal ball, and I wish I could come up here and say, oh, it's going to end on this random Tuesday in this random month. I don't have that answer. And what you're seeing in the market is just a lot of uncertainty. They don't know how long the Fed's going to go in terms of interest rates. They don't know how severe it's going to be. But if you look at various other aspects of the underlying economy, there is reason for optimism. Strong dollar, strong US dollar, that's one reason. The unemployment rate, despite the fact that that's part of what's driving the Fed at the moment, unemployment's still at a record low. So that means people are actually earning wages. So they do have money to spend, although wage inflation is part of the challenge. So it's a really complicated question. And I'm hopeful that folks in DC are very prudent about the steps that they ultimately take to get inflation in check while at the same time continue to preserve transparency, liquidity, all those sorts of things in markets.
And when you think about that, do you feel like there is a stability, at least in the consumer's minds? Even though sentiment is down, we still see decent spending. I mean, the downturn has been in tech stocks, higher risk, right, equities. So there does seem to be pockets of strength. Where would you say?
Yeah, I mean, I think you just look at the way you're spending your money. There was the revenge vacations that we all took after being cooped up for so long. There are all these types of amazing events that are happening where we're convening business leaders, political leaders in person to have conversation. So clearly the travel industry Don't know if any of you had trouble getting flights here, but it's challenging to book a flight at the moment. The travel industry is doing really, really well. That doesn't mean that people are going to not buy that new pair of shoes, buy that new outfit, whatever the case may be on the consumer side of the business. You're just going to have to balance it with the fact that the price for goods are going up.
Is this the new normal that we're seeing, the volatility that is back? Is this what we should be expecting since the pandemic was really an anomaly?
Yeah, that's a good question. I don't think this is the new normal. I think it's going to be the normal until the Fed gives a clear sign that the end is near and starts to take more deliberate steps to stop raising interest rates 75 basis points. The inflation print a couple of weeks ago, I gotta say, it confused me. It confused a lot of people in the markets, mainly because inflation, 8.2%, markets opened down 500, 600 points, but then they had a strong rebound at 900 points. Stuff like that is honestly what is confusing consumers. It's what's confusing retail in the markets, what's confusing the institutional investors. It's also what's slowing down the IPOs coming to market.
When we chatted in April in DC, you mentioned there was a backlog of deals.
Still is.
At the moment, we're still, though, seeing the lowest levels of IPO activity in the US in 20 years.
Yep.
What are they waiting for? How can they get prepared for the timing to be right again?
The VIX being at 30, volatility index being at 30 is not good for IPOs. It's just the way it is. When it gets up to that above 20, really the upper 20s, which is what you see, even if it's not 30, some days it's 35, some days it's 28. It's kind of a signal that the market's not yet ready for the flood of IPOs, the IPOs that are really in our backlog to come to market. That said, we did actually execute the largest IPO of the year on September 15th of this year, where we saw a really strong business, really strong cash generator, really strong profits, Corebridge, come to market. It priced within its range, raised $1.7 billion on its IPO day, and is trading above its IPO price in the market. So that's proving, to me at least, that the market still will consume companies that are high quality, solid businesses that are ready to go to market. So we were really happy, to see the results of that IPO and the continued results of that.
And it's a tough year to compare, right?
It's a really tough year.
Two record years in 2020 and 2021 with IPOs. So I think something that companies keep in mind, right, as they report, let's do a 2-year comp.
Absolutely.
You mentioned some of the other issues that companies are thinking about. ESG is in focus. There is some backlash now against ESG investing, against that word and the term and sort of the philosophy of it. What are you hearing in the rooms that you're in about this particular issue?
Yeah, so I like to say ESG is a market. There's a buy and a sell. Everything's a market, there's a buy and a sell. People have different views. That's what ultimately makes a market. Ultimately, from the CEOs that I'm talking to, the 2,400 companies that we have listed on the stock exchange, which represents more than $30 trillion in market cap, they are looking to embed elements of environmental, social, and governance responsibility into their day-to-day. I don't think anyone can argue the positive effects that, for example, diversity and including additional diversity has had on business. So I don't really think that's up for debate, and that's something that we spend a lot of time with our issuers and with our customers, providing solutions, providing tools for them to further enable diversity. Environmental is a bit stickier only because some of the disclosures are not yet ready to be measured accurately and disclosed accurately. Specifically, something like a Scope 3 emissions target. Scope 3, for those of you who don't follow this in as much detail, is your full supply chain, the environmental impact of your full supply chain. In order to accurately disclose that, you need to have all of your suppliers accurately disclose that. And that's something that's really challenging for some businesses. So it's not that CEOs are not looking to disclose additional information and then let the market decide whether it's valuable or not valuable. It's more that they're trying to figure out how to accurately disclose those sorts of metrics in the market.
From a visibility perspective, though, has there been increased nervousness around marketing a company or a set of investments as being focused on ESG because now we're seeing bills introduced on Capitol Hill, we're seeing state legislatures banning investments. So is that something that you're sensing?
You know, we still see about 40% of money coming into ESG funds, but when you're actually investing in a fund, funds are very public with what their prospectus is, with what their investment strategy is. You think about it in very simplistic form, an equity ETF, for example, that's benchmarked against the S&P 500. That's pretty simplistic. It's benchmarked against the S&P 500. But more and more funds will, embed a ESG filter, be it one that's got more focus on carbon neutrality, net zero, diversity, whatever the case may be. That is all has to be publicly disclosed because all of those funds follow IOSCO principles, which are best-in-class principles. So it's really comes back to people having to do their homework about what they're investing in, whether they want an ESG flavor with a certain lens, environmental, social, or governance, or if they want just your standard S&P 500.
Do you think the label is too widely used?
I think the label may have been too widely used, but it's getting more refined. So carbon is a big area, carbon neutrality. People are starting to zero in on the different elements of ESG. It's funny because for many years people talked about ESG like it was this one thing, when it's really not. Environmental even has multiple lenses on it. Social has multiple lenses on it. Are you looking to do good outward facing, or are you looking to be a responsible employer and invest in your human capital that you have on your payroll? Governance is probably the easiest one that has for many years had really good disclosures in terms of diversity of boards, diversity of leadership teams, those sorts of things. But for a long time, for whatever reason, the diversity thing got put alongside the carbon item. So there are two very different investing strategies.
So you're expecting the E's to be talked about separately from the S's to be G's.
And by the way, I think that's a good thing, ultimately, because it then comes down to giving more specificity to investors, giving more specificity to the market as to performance in any one of those lenses.
And then more measurable on an individual level.
Exactly.
Another sort of squishy idea, stakeholder capitalism. Sounds great, feels good, just say. What does it actually mean?
It's a good question. I think actually if you ask many CEOs, you'll probably get 15 different answers. So that's another topic.
How do you define them?
You know, stakeholder capitalism could, in my mind, there are multiple stakeholders when you're running a business. There are the internal stakeholders, there is your board, there is, if you're a public company, clearly your shareholders. So ultimately, CEO's responsibility, a public company CEO's responsibility is to deliver returns to its shareholder, but to do so in a responsible fashion.
Now, when we talk about, marketing companies to public, I miss being on the floor of the stock exchange IPO day. I mean, it's a wonderful experience, and it's very exciting. But I'm wondering now, with retail investors driving news cycles and obviously the markets, how has that changed when a company decides to go public?
So I think that fact that there's retail investors, continued prolonged retail investors, new class of retail investors in the market is ultimately a good thing because it allows a different investor base to share in a company's success. So I think that's ultimately a good thing. The retail as a percentage of the market obviously hit peaks during the pandemic when we were all at home, locked down, whatever the case may be. You've seen retail come off a bit this year. Probably because they're trying to figure out what the market is doing. Is the market meant to go up? Is the market meant to go down? So I think the volatility may have some retail sitting on the sidelines, but ultimately we see retail participation continuing to be just further proof that public markets are good. Public markets allow democratization of returns and delivery of returns to a much broader shareholder base.
What's driving the markets more, geopolitical tensions or what the Fed is doing?
I think what is driving the U.S. market is what the Fed is doing. But you can't be sure on any one given day. I mean, even the day, I remember February 24th when Russia invaded the Ukraine, I think the market was down 900 points. So really depends on any given day.
Lastly, what role do capital markets play in bridging divisiveness between countries?
Yeah,
Especially
I think
if you look at the president of Ukraine spoke, and we know the delisting issue with Chinese companies has become, a hot button one. I mean, how do you see your role in helping to maybe close those bridges?
So I think the NYSE has a really unique role to play in global capital markets. I think the U.S. is the home of global capital markets, and if anything, NYSE is the platform for those global capital markets. It's really something that led us to form something called the NYSE Institute in July, because I think that business-minded people can figure out solutions in a very different fashion outside of the geopolitical tensions. It's what's led us to this year sign 3 different MOUs with local regional exchanges, including SGX, Japan, and most recently Johannesburg, because in my mind, we're here to continue to allow capital to flow and to have common standards to the extent possible, allowing that global capital to flow.
Lynn, we have to leave it here for today. Thank you so much for joining us.
Thanks for having me.
Thank you, everyone.